Watch this video if you want to learn how to take advantage of the equity in your home in today's market. I'm Amanda Ray with Guild Mortgage. We're going to talk about how to get the equity out of your home. So there's two main ways that you can take advantage of the equity in your house. One is called a cash out refinance. The other one is called a home equity line of credit. They're both great. It allows you to use the equity in your house, but there's pros and cons with each. So one thing that we'll do when people come to me and they say, hey Amanda, I have all this equity in my house, I want to use it. I'm gonna look at both options for them because one's not always better than the other. We need to weigh the pros and cons of each and make sure that they're making the right choice. So let's talk about first the cash out refinance. So how it works is you're going to refinance your first mortgage. You already have a mortgage, you're gonna refinance it, but just for a larger amount. Say you owe $200,000 and now you refinance it for $300,000. That $100,000 difference, that's yours. That goes right to you. We write you a check for that. That's the cash out refinance. Take your smaller mortgage, turn it into a larger mortgage. So some of the pros with that, you'll only have one mortgage payment. Most first mortgages are fixed rate mortgages. So your mortgage is gonna be a fixed interest rate. Some of the cons, if mortgage rates have gone up since you got your last mortgage, which if you bought in the last couple of years and now you're refinancing now, they probably have, you're going to get a higher interest rate. Say your mortgage right now, your $200,000 mortgage is at 2% interest, and you refinance today for that $300,000, we give you that check for the $100,000. Well, that $300,000 mortgage is at today's interest rate, which is around 6.5%. So you'll turn your 2% mortgage into a 6.5% mortgage. That's usually the downside that people are looking at if they're refinancing right now. Let's talk about the second way, the home equity line of credit. So your first mortgage stays exactly the same. You're taking out a second mortgage, an additional mortgage on your home. The pro is that you get to keep, if you have a really low interest rate on your mortgage right now, you get to keep that low interest rate because we don't touch your first mortgage at all. It stays exactly the same. You're just taking out a second mortgage. Some of the cons might be you have now two mortgage payments. Instead of just paying one larger mortgage payment, you're gonna pay one payment and then the second payment on the second mortgage. Another con is that home equity lines of credit are usually an adjustable rate. It's not a fixed rate like your first mortgage. Adjustable rates have kind of a negative connotation. Sometimes people are afraid of those. They're afraid of their mortgage adjusting, but it might not be a bad thing. You know, if you keep one mortgage really low and the second mortgage is higher, it could still even out to be better than taking out one larger mortgage. I don't know. That's why we look at both of them for you. With the home equity line of credit, think of it like almost like a credit card, but you have on your house. It's a line of credit. So say for instance, you wanted a $100,000 line of credit on your house. You get a home equity line of credit for $100,000, but it doesn't mean that you have to use the whole $100,000. You only have to use the part of it that you want. Some people like to take out a bigger line of credit than they actually need because then that money's always there. They're always able to borrow from it. So say maybe you only need $20,000 right now, but maybe you'll need more money in the future. You can take out that home equity line of credit for $100,000, only borrow $20,000 to do whatever projects you need to. Do something around the house, pay off your credit cards, whatever you need the money for. And then you could pay it back, you could borrow it again, maybe you don't pay it back and now you have another project you want to do. You still have that whole line of credit, so you can just keep taking money out of it anytime you need to. For myself personally, I have a home equity line of credit on my house, and I don't always use it, but sometimes I use it because once it's open, it's so easy to borrow from. You don't have to keep reapplying with the bank. You have that line of credit that's there, and it just go in, use it, take the money, pay it back, just like a credit card, but it's gonna be at a lower interest than a credit card. So that actually could be another pro versus doing that cash out refinance. Because the first option we talked about where you took the $100,000 out as a cash out refinance and we wrote you a check for $100,000, well, you're paying on that whole $100,000. Maybe you took out too much, maybe you didn't need it, maybe you didn't know how much money you needed. Whatever amount you take out, you're paying on the whole thing. Whereas the home equity line of credit, you're only paying on the part that you're using. And normally, when you take out a home equity line of credit, it's open for 10 years. So that means during that whole 10 years, you can keep borrowing from it, pay it back, borrow from it, pay it back. You'll have that line of credit. So the point is, there's two options. I don't know which one's best for you until I talk to you. We're gonna explore both of them. We have both products. So if you have equity in your house, you wanna use it, come see me. I'm Amanda with Guild Mortgage.